If you are trying to make the decision between having your business set up as an LLC or as an S-Corp, I want to explain to you the key differences in the way that LLCs and S-Corps are taxed and how this affects potential savings or potential costs that you could incur with either. Hi, I'm Ginny Silver. I'm the founder of the California Entrepreneur Collective and contributing author to Entrepreneur Media. While the LLC is a separate business entity, for tax purposes, when you file your income taxes, that LLC business entity is going to be what's known as a disregarded entity in the eyes of the IRS. That business entity will be disregarded and the income and deductions from the LLC will flow through to your personal tax return. You're going to file this on Form Schedule C. Now, this is the default way that an LLC can be taxed. If you form an LLC and you file all required paperwork and register with the Secretary of State, then your LLC will automatically, by default, be taxed the same way as a sole proprietorship if you're a single member LLC. But once you form an LLC, you then have the opportunity to file additional paperwork to elect what is called S-Corp taxation status. This means that instead of going with the default method of being taxed as a disregarded entity and having that income pass through to your personal tax return, electing S-Corp tax status is going to require you to file an additional piece of paperwork with the IRS. Now, once you file the paperwork in order to be taxed as an S-Corp, the following changes are going to take place. Number one, you must hire yourself as an employee. This means everything that goes along with payroll, workers' comp, and any other labor laws that are applicable in your state. You must follow them and you must hold those policies and procedures. Hiring yourself as an employee is going to mean that you must have a payroll system in place, which is going to have additional expenses each month for running payroll. Additionally, you're going to have to register with your state's employment board. In the state of California, my home state, this is the California EDD. You must register with that state employment board and you must keep your account in good standing and up to date with all required paperwork. Additionally, many states are going to require you to hold workers' comp insurance. This is going to be an additional expense monthly that you pay in order to hold workers' comp that your state requires for any employees. Even if you are the only employee, you still are an employee of your business and you're going to be obligated to hold workers' comp insurance if your state requires it. Next, you're going to be obligated to pay yourself a reasonable salary. Reasonable salary is loosely defined as the compensation that would be a fair market amount for paying you for the work that you do within your company. This salary is going to be what is put on your payroll and what you are paid through payroll with payroll taxes taken out. Because you are both the employer and the employee, you're going to pay both portions of that payroll tax. Everything outside of that reasonable salary will be transferred to you in the form of what is known as an owner's distribution. An owner's distribution is when the profits of the business are transferred directly from the business bank account to the owner's bank account. Now, here is where the potential tax savings lies. If you are an LLC and you are taxed as a disregarded entity, all of your business income is your personal income and all passes through. You and your business are essentially one and the same. Even though you have an LLC, you are taxed as a disregarded entity. So all of the business income is going to be subject to self-employment tax. Self-employment tax is a tax that those who are self-employed are obligated to pay. It amounts to 15.3% of your net income. This breaks down into a portion for Social Security and a portion for Medicare. Therefore, in addition to federal and state income taxes, this additional 15.3% tax is going to apply to all of your business's net profits. However, if you have elected S-Corp tax status, you are not going to be taxed the same way. Your reasonable salary that you pay yourself through payroll is going to be subject to paying payroll taxes, which also equals 15.3%. However, the tax savings is in the owner's distribution portion. Once you have paid yourself that reasonable salary, everything left over in the business as profits can be transferred to your personal bank account as an owner's distribution. This owner's distribution is not subject to payroll taxes because it's not employee salary, and it is not subject to self-employment tax. This means that you are going to save 15.3% on that amount that you transfer as an owner's distribution. Now, this can mean a really big tax savings, thousands or even tens of thousands of dollars for those of you that are in a higher income earning bracket. However, for those of you that are new in business or have a lower level of income, it may not be worth it because of the additional costs of running an S-Corp. Because you must put yourself on payroll, you must pay payroll expenses such as a software that you pay for each month. Additionally, if you have to get workers' comp insurance, you must pay for that as well. This can also affect your deductions that your business is able to take on your income taxes. Businesses are allowed to take the QBI deduction, the Qualified Business Income Deduction.
The QBI deduction allows a business to deduct 20% of their qualified business income, which will result in lowering their taxable income. As a sole proprietor, all of your net income is qualified business income. However, as an S-Corp, you pay both a salary as well as an owner's distribution. The salary is not qualified business income in this case. Therefore, the QBI deduction is only going to apply to the amount that you take as an owner's distribution. For many, this will significantly lower their QBI deduction amount.
That QBI deduction is only going to apply to what you take as an owner's distribution, not the entire amount. This can be really complicated to figure out exactly if it is worth it for your business to elect S-Corp tax status and exactly how much you could potentially save, or if it is going to cost your business money due to the additional expenses and lowered deductions with the QBI.
For those of you who need a visual, let me recap this in simple terms.
If you file the additional paperwork with the IRS to elect S-Corp taxation status, then you're going to be required to hire yourself as an employee of your own company. This means several different additional expenses, such as payroll costs for either hiring a bookkeeper or getting a payroll software, staying compliant with your state's employment laws, which oftentimes includes getting workers' comp insurance, which can be an additional monthly expense. Now, once you've hired yourself as an employee, then you are going to break down your income into two different ways of receiving that income. This is going to be paying yourself a reasonable salary and giving yourself the remainder as a distribution. Now, you're required to give yourself a reasonable salary, so let's just go ahead and put 50% into your salary and 50% into a distribution. From that salary, you're going to be required to pay payroll taxes. This is going to be that Social Security, Medicare, and other expenses. Your distribution is not subject to payroll taxes, and it's not subject to self-employment tax, which is the big tax savings here. You're going to save 15.3% in taxes on what you receive as a distribution. Now, the next expense here that is never covered in these other videos is the QBI deduction. This is the Qualified Business Income Deduction, and it allows owners of pass-through businesses to claim a tax deduction worth up to 20% of their qualified business income. Now, you can only claim this on the amount that you receive as a distribution, not on the salary portion, which means only 50% of your income here is going to receive that QBI deduction. Now, if you're a sole proprietor or if you are an LLC that did not file S-Corp taxation status with the IRS, you are defaulted to a pass-through taxation status. And if you're an LLC, you're what's known as a disregarded entity. You equal your business in terms of your business income taxes. All of the income that comes into your business is yours, and you will pay yourself using an owner's draw, a simple transfer from your business checking to your personal checking or writing yourself a check. Now, this then means that all of your self-employed income is going to be subject to federal and state income taxes, and all of that income is going to be subject to self-employment tax, which is 15.3%. And that tax is going to be applied to 100% of your net income. Now, 100% of this self-employed income qualifies for that QBI deduction. So you are going to see a difference here between the amount of your income that qualifies for the QBI.
So filing to have your business taxed as an S-CORP means a lot of different changes for your business. So before you do this big change for your business, there are some very specific things that I want to make sure that you understand. Yes, this can equal big savings, but it also can equal way too many expenses that you are not ready for. So first, before you file, check and make sure, can you handle the extra expenses? Payroll, running payroll, all the expenses associated with that, like workers' comp and staying compliant with your state. Can you pay yourself a regular, reasonable salary? Is your business income stable and steady and large enough to pay yourself that regular salary? Next, what are the things you're going to need to do to stay compliant within your state and your state labor laws? Make sure that you fully understand those obligations. Next, does the change in the QBI deduction outweigh the tax savings from self-employment tax? The only way to know this for sure is going to be to consult a tax professional.
I highly recommend that before you choose switching to an S-Corp, that you consult with a certified tax professional. Okay, you guys, I hope that was helpful. Let me know your questions down in the comments.